I do this in the in-sample data. Once I've done this, I can now calculate the standard deviation from, I can do this parameter sensitivity testing. I run 1,000 runs, and I can calculate the standard deviation of those 1,000 runs. So if I picked a strategy that has a CAR of 20, let's say, and I do my parameter sensitivity testing, and it comes an average of 15 with a standard deviation of 2, what I picked is 2.5 standard deviations away. And that to me is a huge sign that, I've way overfit.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Welcome back, traders, to the Algorithmic Advantage. Really happy to be speaking with Cesar Alvarez today from Alvarez Quant Trading. Cesar, welcome to the show.
Hello, Simon. Thank you for having me here. Great pleasure to be here and be one of your guests.
Looking forward to it. Yeah, cheers for participating. Cesar, I know that you want to jump straight into it like I always do, but I know that you, started discretionary trading, I think, in the late 90s.
Yes, I started. Right? That's about right. I probably went through a very similar path for a lot of people. Started first with mutual funds, trying to trade mutual funds, then got into fundamental stocks, did a little bit of William O'Neill stuff for the people who remember IBD. And then probably late 90s, early 2000s, I started discovering quant trading, or just, how to quantify stuff. And also around that time, I discovered Amibroker, which allows you to test those kind of things. And that's where my, it's like, oh, wow, this is, for me as a computer programmer, that really kind of resonated. It's like, hey, rules and whatnot, that's my world. And, I did that for a few years. And then in, probably, 99, 2000, I also discovered tradingmarkets.com, or actually probably then was called tradehard.com. They got changed to tradingmarkets.com, run by Larry Connors. And, I bought a couple of his courses. Eventually, I took a live course with him. And, I took the course. It was what I would call a pretty classical mean reversion strategy. We finished the course, and I told him, hey, look, I've got this programming experience. I used to work in Microsoft Excel. I don't have any trading experience, but if you're looking for somebody to help you out, I would love to help you. And he says, well, thank you very much. And politely said, no thanks. I was like, okay, I wasn't expecting it. 6 months later, I sent him out an email saying, hey, it's me again. Are you interested? And he goes, oh, no, I'm so sorry. No, we're not interested right now. It's like, okay. 6 months later, I sent him another one. Hey, I'm still me. He goes, oh, we just hired somebody. So sorry about that. About 6 months after that, he sends me an email saying, hey, we need another researcher to verify some numbers that we're getting. They're too good to be true. So we need a, second verification. He started it as my one-time job. Yeah, that's my first job with him. And then from there, I spent 10 years with Larry learning all about mean reversion and some volatility trading.
So exciting because there's a lot of us who do mean reversion trading, and we've learned directly or indirectly through yourself, Larry, those kind of channels. So it's definitely interesting to talk to you about that. What was it like day to day there? What kind of stuff were you working on?
Oh man, Larry's a fountain of ideas. I was always impressed on just how many different ideas he would have. I mean, day to day, it was, always a huge backlog of him sending me emails first thing in the morning. It's like, okay, here's my idea, going out, testing ideas, trying different things, really changing, our views on things. Like one of the biggest things for that we learned early on was stops on mean reversion. One of those things, he said, okay, I got the strategy, mean reversion, figure out where the best place, optimize where the best stop is. And I slowly started working away and slowly moving the stop further and further away. I remember that time I was like, you're not going to believe the answer to this question. The best stop is having no stop. And that was like to me, it was like one of the best kind of research findings we ever had. It was like, wow, that's just so counterintuitive to everything else. But that's what happens when you can actually test these things. Back then, there was not a lot of testing software. Not a lot of people were doing this kind of testing. So it was very interesting.
Over the time, things. 9-10 years there, did you see a change, and particularly say as the markets changed, was there a change in emphasis in strategies, or were there particular things that developed deeper and deeper?
During those, so I started working I worked from 2003 to 2013 with him. And during that time, at least through 2003, I'd say through 2009 or 10, the markets were mean reversion was really good for those markets, or other way around. So for us, it was always trying to find different ways of looking for different kind of pullbacks on things. So that was a lot of his focus was on that.
Let's jump into how you're trading today. You've got all that background. You've been building strategies, educating, training others. You offer a bunch of services on your website, which I'd love to get into at some point as well. But just give us the high level of what you are trading today, kinds of markets and timeframes and strategy types.
So yes, I've definitely from back then I was all purely mean reversion trader. Since then, I've definitely expanded quite a bit. I still trade mean reversion, though now I much more on mean reversion on the long side, mean reversion on the short side. I also now trade breakout strategies. I have a small cap breakout strategy that I trade. Another thing that I trade is what I would call a NASDAQ 100 momentum rotational strategy, kind of a little bit of combination momentum rotational. That one is on my signal service there. I also trade several ETF strategies. One is a SPY TLT strategy, kind of rotating between those two, deciding which one's got the bigger momentum. I also have a bond rotation strategy that I trade. Sometimes it takes advantage of the falling interest rates or things like that. Though it does have one of the ETFs it does trade is the inverse 20-year bond, so it can take advantage of the other thing. What else is on another one is volatility, where I trade the VIXy and SVIXy. That one's always that's a difficult one to trade because it can either catch on fire or just be burning down, just going downhill. That one's one of those hit or miss ones that just when it's doing great, it's great. When it's doing lousy, it's doing lousy. So that's what I would call my trading kind of universe of strategies. I also have what I would call a much slower kind of method where I trade something like a tactical asset allocation dual momentum strategy with about 8 ETFs or so, 8-9 ETFs that trades maybe once a month or once every 2 months kind of thing. So much slower, kind of my safer investment strategy kind of things, where I'm now at the age where I am thinking about retirement. So I'm now less thinking about total return and more thinking about drawdowns. And that's, that one's really focused on keeping those drawdowns small. I'm willing to give up quite a bit of return to keep those drawdowns small.
Yeah, absolutely. And it's really valuable to have those kind of strategies in the mix anyway. And especially different people have different requirements, like you say, at different stages in their life. They're very popular or very important strategies, popular perhaps. So tell us a little bit more about that one. Like, how has it done, for example, in the recent chaos, March, April 2025?
Actually, surprisingly well. Let me explain how it works. There's the kind of the tactical asset allocation part is there is an equities portion, a bond portion, and a real assets portion. And at first I decide, what percentage do I want in each of those 3 buckets? I'll say I don't remember the exact proportions, but I think it's something like 40, 40, 20. So my equities portion, I have basically 2 ETFs. I have the entire market and then small cap value. In my bonds portion, I have high yield bonds, long-term bonds. And then in my real assets, I have gold and commodities. Now, of course, you can change those whatever you want. Better choice would have been for this year would have been to having U.S. stocks and foreign stocks would have been much better. But yeah, so that's the way I have those 3. And then within each of those buckets, so let's just take the equities bucket, I do kind of the dual momentum idea now. I take each one, I say, okay, I do the absolute or the relative thing first. It's like, okay, which one's ranking better? But I have 2 different ranking methods. So I say, okay, using ranking method 1, which one's doing better? And is it absolute then I do an absolute rankings that pass, beating cash, just keep it simple. That gives me one of the ETFs. And then I do the second with the other ETF, or the other ranking method. What that gives me now is the possibility of being fully 100% into one ETF or split 50-50. Or maybe potentially that all be in cash. What's been happening lately is that's all in cash, which, you know what? Cash is good. When markets going down, and markets are going crazy, cash is good.
Cash so is that's underrated, we were saying last time.
I believe cash is severely underrated. I mean, as traders, and I know I was this way, I didn't like having cash. But after a while, I realized, you know what? Cash is a short position on the market, or a short view of the market is the way I now look at it. So for me, I've been lucky so far this year in the sense of my equities portion has been mostly in cash. My bond portion also, I think, has been between cash and high yield. And the best part is my real part has been sitting in gold. And gold, I think last time I checked, was up, 30% for the year. I don't know.
Doing
where
really
it is.
Well, yeah.
Yeah, so it's been quite, I'm not hitting it out of the park, but mostly, here's the thing, back to what I'm saying. For me, it is avoiding those drawdowns. And, that part of my account is actually up this year. Or it got hurt a little bit at the beginning because it only trades once a month. So, it doesn't, it can't get hurt intra-month. But I think it is sitting up this year because of the gold. To me, it's doing exactly what I would hope it to do. Yeah.
Have you ever tried something like that with a lot more ETFs than 8?
So really, well, I guess it's 6. It's in a sense, it's depending on how you want to count, because it's for the equities. It's for me, it's U.S. small cap value, and then it's SHI, which is the short term treasury one. So in a sense, I could be there are 9 that I use.
Right.
The short answer to that is no. I've tested more. Adding more just does not help at all.
Yeah.
It sometimes even hurts. I thought, like you, wife, I've got my, now how about if I add this? And how about if I add that? It just muddles things. And for me, when I add complexity, I want to see a big jump. I don't want to, yes, adding one little ETF is like, if I add this one, it slightly tweaks the numbers a little better. But to me, if I'm adding more, I should see a nice little improvement kind of thing. And something special with ETF strategies, especially something like this one, is you have to be careful on what ETFs you choose or how much time you spend picking your ETF basket, because that is you can very overfit that, in a sense that ETFs you choose can have a really huge impact. So if then it's like, well, maybe I want to do, the reason I chose small cap value is because from a tactical asset allocation point of view, that's a really good ETF to have. But maybe I would discover, having, mid cap value is really good. Well, there's no real tactical asset allocation why that's good, other than if I put it in, it makes my numbers look better. And now you're just curve fitting by adding ETFs. And that's the problem whenever you build strategies using ETFs that are not like what I would call, as soon as you start going beyond your, this is what I want, you can really start curve fitting.
Is that a strategy that takes all its trades, say, at the beginning of the month?
Basically, yes. Yep.
Do you have any kind of intra-month stops or targets that might work?
No, don't even look at it intra-month. It's like, I try really hard not to look, even though I can generally know what's happening. But it's like, no, just wait till the end of the month. That's how it was tested. It's had other bad intra-months kind of thing. Though the hard part, especially for any strategy, is this time period we're in now, where we're near the 200. So we can't really decide, do we really want to get ourselves into a bear, or are we just kind of faking a bear and going back into a bull kind of thing? A lot of strategies struggle during this kind of potential transitionary period. This kind of longer term hold strategy is like, just leave that one alone. I have not even looked at getting out with a trailing stop or anything like that in the middle of the month, because then I need to pay attention to it in the middle of the month. And it's meant to be really simple for me to only worry about once a month.
I guess this speaks to designing strategies with a specific purpose, doesn't it? So
yes.
Tell us a little bit about your approach and if it's a goal-orientated approach like that, your approach to building strategies, designing something, and then maybe even something about the testing and the robustness testing that you would do on that.
Yeah. So like you said, every strategy that I build has a particular, there's a particular purpose or kind of idea behind it. Let's say it's short strategy that I just, okay, it's like, okay, I want a short strategy. Usually I know what universe I want it to be on. So it's like, okay, I want a short strategy. I want it to be on, let's say, S&P 500 stocks. Because it's short, I probably want short-term holds. So I have general ideas of what I want. Also, I'll have general ideas of target returns, target drawdowns kind of thing of saying, okay, I'm shooting for returns. I'll be happy if I'm the high teens, the low 20s, whatever that value may be, depending on what I'm trying to do. Because it's short, I know I'm going to have to deal with higher drawdown, so maybe up to 35% drawdown. Anything like that is, all those things go into before I start going in. So every strategy, in a sense, has a general goal to it. So like one of the most recent strategies I had was an S&P 500 mean reversion strategy that I actually just put on my signal service called Rocket Rail. It was like, you know what? I already have right now I'm already trading personally a mean reversion strategy on Russell 3000 stocks. Okay. And I said, you know what? I want to see if I can get a mean reversion strategy on S&P 500 stocks. They trade differently than the smaller stuff does. So, I went in, it's like, okay, S&P 500 is my universe. Okay, I know because I'm trading S&P 500, I'm not going to get, big of numbers. So, okay, somewhere around 20% is going to be fine. Buying your returns. And that gave me that, that kind of gives me my box and my goals of what I'm shooting for when I start creating the strategy.
You've got this goal-orientated approach because you're trying to potentially, fill potholes, as Lawrence Bensdorp has said on the show in the past, or build things for a specific goal, retirement account, that kind of thing. Yeah. I know it's probably I'm reversing the order that I would normally talk about these things, but just to jump into the robustness testing a little bit, I guess the process of deciding that a strategy is robust and the kind of testing and the kind of process that you would go through to make sure it's going to work out a sample. Do you have some core principles there?
Yes, there is. Basically the same thing. I'll do this on any of my strategies. This is the way I kind of decide. Because our software is powerful and like something like Amibroker, you can run optimization tests and get, thousands, tens of thousands, whatever. I mean, you can get lots and lots of runs, lots of parameters. Yeah, I don't want to run 10,000, but some number, a couple hundred, maybe 1,000 runs. But even then, it's like, well, how do you pick one? How do you know you pick one? So, when I start looking at that is, it's like my first general rule is like drop the first 10%. The first 10%, I can't even touch. I can't choose any of that parameter set. I don't stay that parameter set because I assume that parameter set is the overfit, got lucky parameter set. Now I start looking down below, and eventually I will find something that looks like it fits what I'm looking for, both on a risk, return, what other goals I had in mind. From there, then comes the fun and interesting part is I like to do parameter sensitivity testing. And so what that is I tweak the parameters. Let's say one of the rules is 2 PRR size less than 10 is the entry rule. And then I will vary that like 10 or 20% around that. So I will test values between 8 and 12 randomly. And I'll do this to all the parameters. I'll do this to the entry parameters. I'll do this to the exit parameters. I'll do this to importantly also, which I think some people forget, is the ranking parameter also, because that can have a huge impact. So I do this parameter sensitivity testing on it. I do this in the in-sample data. The idea is, once I've done this, is I can now calculate the standard deviation from, I can do this parameter sensitivity testing. I run 1,000 runs, and I can calculate the standard deviation of those 1,000 runs, so that parameter sensitivity testing. And what I want is the average of those 1,000 and the standard deviation compared to what I picked, hopefully this is making sense, to be basically less than a standard deviation away. So if I picked a strategy that has a CAR of 20, let's say, and I do my parameter sensitivity testing, and it comes an average of 15 with a standard deviation of 2, or make it 2.5. So this is what I picked is 2.5 standard deviations away. And that to me is a huge sign that, I've way overfit. To me, it would have been, okay, I picked the CAR of 20, I do the parameter sensitivity testing, it gets a CAR of, let's say, 19 with a standard deviation of 2. It's like, oh, great, I'm within 1 standard deviation. I've likely not overfit. So that is my first step, in a sense, of trying to find something that is not for parameter sensitivity testing says you're not way over from what, you tweak the parameters. Normally, maybe the first one, I'd say half the time is still like maybe 1.5, 1 to 1.5 away. I'm usually don't go far enough down the list in a sense. And usually the second choice or the third choice will get me, okay, now I'm within one standard deviation, I'm feeling comfortable. That's all done within in sample. Now it comes to my out of sample. This is where I get, in a sense, one bite at the apple, but I do it slightly differently than most people do. So with my out of sample data, I also do parameter sensitivity testing.
Okay.
Because now I want to see, so I don't just run the same parameters, because often people just say, okay, let me take the parameters I have, run in my out of sample. How does it look? Could it look good or could it look bad? The problem with that is, well, that particular set may not look great, but if you do a parameter sensitivity run, it all may look fine, the average of the parameter. So that's why I do out of samples. I do a parameter sensitivity run on the out of sample and took the average of that and say, okay, how does that look? Not just the one set of parameters I picked. Because again, small tweaks will happen of whatever. So that is how I kind of do that. And I take, as everybody says, you only get one bite of the apple out of sample. And, it's, and it's sometimes really hard to say, oh, maybe I'll take another bite of the apple kind of thing. So that is, and I had to have toss things. Okay? And usually by then, if by the time I've gotten to the out of sample, and if it fails, usually I could tell when I'm doing the in sample picking that it's this is just not feeling right. And I can almost tell you ahead of time, it's just not going to work out of sample. And it's like, yeah. And it's like, okay, oh, well, this idea is not the best. Something between, I think, Alan Clement's interview. So we have different views on in sample and out of sample data. I use the most recent data. So I'll use often 2008 to the present as my in sample, and either 1995 or 2000 to 2007 as my out of sample. My reasoning for this is I know markets, since I've been trading long enough, I know markets change. And I can give you if you were to build a mean reversion strategy for the 2000s, it would not work now. I can tell you that right now. The markets have just changed too much. But you can reverse it, and I can take a mean reversion strategy here that doesn't work. Yeah, it's not going to do as good as it could have done in the 2000s, but it will still work in the 2000s. But I know it will, or I have higher confidence that I've now tuned it to the current market conditions. So, that's the way I like to use in sample and out of sample.
Yeah, right. I guess a related question then is deciding if and when and how to turn a strategy off, or to decide that it's failed. And I know that you tend to, and I think it goes along with that kind of build process when you're building logically in that way with a specific set of goals. Generally speaking, you want to build something that's going to be robust for quite a period of time, I imagine, and you want to let that go for quite a period of time, and you're going to be very hesitant to intervene and turn it off. But what is your thinking around that, and how do you review strategies on a quarterly basis, I believe, and then how would you decide that one's, actually not fit for the current market anymore?
Yeah, so I actually have a different view on that, in the sense of, I believe it is impossible to know until you've been trading a strategy for 2 or 3 years after a strategy is broken that it's really broken. Most strategies that break don't break by going straight down. They break by slowly their equity curve drifting down. Yeah, maybe they'll have a little dip down and kind of rally. And to be trading a strategy, a year, 2 years, 3 years before you realize, oops, I shouldn't be trading it, just did not seem right. I want to say now, probably 2018 or so, I finally came onto a method that works for me. So I have what I would like to say, I have about 10 strategies in my trading stable. I have, you've heard a lot about, I got my mean reversion strategies, I got my breakout strategies, I've got my, my SPY TLT strategy. I've got all these, I've got 10 strategies in my trading stable. What I do is every month I rank them and I trade the best 5. And through testing, I have learned that this will get me out of strategies that are dying. So in a sense, I'm just kind of saying, okay, let the best go up to the top. And more importantly, let me stay out of the ones that are slowly they may be breaking. And it has worked quite well to get me out of strategies that I've kind of wonder if this is broken. It's it's rotated out. And then, I'm like, God, I haven't traded, that has not rotated in over a year and a half. And I'll look, I'll look at the equity curve and it's like, oh God, it definitely looks broken. It's like, yeah, then I'll just take it out of if it hasn't rotated in like a year and a half to 2 years, then I yank it out of the stable and I just say, okay, it must be broken.
Yeah, I've just finished up a round of interviews with some shorter term futures traders like Kevin Davey, Andrea Unga, and these guys in particular definitely have that kind of process of having a lot of models on the shelf, and the ones that are performing in the current market are being deployed, and the ones that are not, they're back on the shelf or on the bench. I can't say I've really heard of that process before for someone trading equities and ETFs like yourself. So that's quite novel right there. I mean, they're obviously trading very short term. You're trading longer term stuff. So you've probably got a slightly different process. But what does it look like then? How are you deciding what is performing in a current market?
It's a very simple, it's just a simple rate of return method that I'm using. It's nothing complex. It's very simple. It's like, okay, what's been performing well over the last 6 months, or I don't even know the exact number, but it is simply as simple as that. You can say, pick your time frame that you want to say. It's like, okay, and it's difficult. And do you sometimes get on the wrong side of things? Yes, because all of a sudden, things change. But it's you kind of could you do it more often? Yes, more often actually gets you slightly better results. The problem with more often is now you're dealing with getting it in out of trades that are middle of trade cycle.
I was going to ask exactly. Yeah,
and that's never fun to do in the sense from a psychological point of view. I know from a complete trading and mathematical point of view, it does not matter because that's the way the equity curves are just going and whatnot. But psychologically, it's just nobody likes exiting or entering in the middle of a trade. They want to see it to its real exit kind of thing. So yeah, and it's like, okay.
So was that the process that you used to actually make sure you exited the strategy? I guess to free up cash for the other strategies, or could you leave them?
That is the process. Since I do this quarterly, it doesn't feel so bad.
Yeah.
So, if I was doing this monthly, I think I'd be kind of more, especially because some of these strategies have longer holds. If it's a mean reversion strategy, no big deal. But some of my strategies can have multi-week holds. And getting out in the middle kind of feels, didn't have time to potentially make its run kind of thing. So yeah, for those, it's just like, okay, I'm supposed to get out of these. I'm not trading strategy. I'm not trading this strategy anymore for this next quarter. Okay, get out of its positions. And what am I trading? It's the middle. It's in the middle of a position. Okay, just get it. Though, for something like a mean reversion strategy, I'll just wait to the new signals. I'll get out of them right away and then just wait for the new signals. Just because, those trade so often. But anything that holds more than a week, it's like, no, just get out of whatever you're in and, and get into whatever you're supposed to be into.
So I've got the same question that I had for the other guys, which is in this case, if you're going to deploy a strategy and then sub it off, sub it in, sub it off, how do you work out what to expect from that strategy, I suppose, and how do you develop a level of comfort that you're not switching it off in the worst times? And
so the way that comfort comes in is from testing my strategy rotations. What I do is I test that, and I can see, oh, look, doing, rotating the strategy gives me overall, because I can compare it to, in a sense, a buy and hold kind of thing, a buy and hold of the strategies. And I can see, oh, look, I'm getting very similar performance, or actually getting better drawdowns. I can see what I'm doing. I think if I remember correctly, I get about the same general performance as buy and hold if I had all the strategies back then. The problem is it answers the biggest question for me. What do you do? How do you know when to stop trading strategy? That's the hardest question. And not having to think about that at all, I'd be willing to give up 10% total return or 10% extra drawdown, to know that I don't have to worry about the question everybody asks. How do you know when to stop trading a strategy? My answer is I don't. It just gets answered for me.
Yeah.
And that to me is worth the extra headache and and the worst, and it does happen. Do I sometimes get out of strategy just to see it next month bounce up and go like crazy? Yes, it happens. It's annoying as hell. But I know it's part of the thing because I know through the back testing, doing this overall, I still get similar results kind of thing.
So just thinking about your usage of Amibroker there, and I want to talk about RealTest then for a second. If you're using Amibroker, have you had to build some custom tools in VBA or something that would make it easier for you to do this testing? Like, can you do, say, a Monte Carlo test or parameter sensitivity test on the whole portfolio as it's subbing strategies in and out?
So the way I do this in Amibroker is for each of my 10 strategies, I export out the equity curves. And then what my strategy rotation idea is trading the equity curves. So then I can then do any parameter sensitivity. If I'm doing, let's say, a 6-month rate of return, I'll just make it 120-day rate of return. Yeah, then I can do parameter sensitivity on that right there. And since I'm just trading the equity curves.
Right, okay. So you can do all of that then in Amibroker. You're basically trading the equity curves, right? Have you had to play with RealTest? Of course,
yes.
Some of us have moved from the Amibroker world to the RealTest world where we can do that multi-strategy trading a little easier.
Yes. I've not done that in RealTest. I do use RealTest. I just have not had all my strategies ported, or I'm in the process of porting over all my strategies. There are a couple of things that I do that actually cannot be done in RealTest currently that I've had feature requests to Marston for. So I, even if I wanted to, I couldn't do my current thing because of current limitations in RealTest. I think RealTest is a really good platform for beginners, intermediate kind of people. At the end of the day, I do think Amibroker is, if you really want to do some crazy stuff, Amibroker is going to do it. There's certain things I do in Amibroker that I know there's no chance I could ever do in RealTest.
Do you want to give us a few of the pros and cons, I guess? Like, what are the advantages of Amibroker? What does it allow one to do? What's the flexibility add, I guess?
The bigger flexibilities are things that most people won't see. Testing of option strategies. Not easy to do in Amibroker, but possible. I mean, it is a royal pain in the ass, but it is possible to test things like that. Intraday strategies are another thing that can't be done. Another thing is any strategies that relies on timeframes higher than monthly, or I think like quarterly. Anything that uses like quarterly timeframes. Or I can forget now what other. RealTest currently does not do. It handles, and then if you start getting into really complex, crazy.
If you want to custom code something, I would imagine.
Yeah, crazy position sizing or crazy, kind of weird, not crazy, but just very different, very custom. But again, this is for 95% of the people, 99% of the people. I would recommend RealTest to most people. Unless you're going to want to do intraday testing, or unless you're going to want to do options testing kind of thing. Or oh wait, I've got this really complicated position sizing or some other stop kind of weird thing, then yes. But like I said, for 99% of people, I think RealTest, is a better way to go potentially. Yes.
In a nutshell, I guess you've got a bunch of strategies that you offer signal services for on your website. Does that broadly represent, by the sound of it, the strategies that you're trading?
The website has, I believe, 6 strategies on the website. Of those 6, 5 of them are in my what I call my trading stable, and then I have 5 that I have my own that I do not share on the website. Mostly, the only reason I don't share them on the website is they tend to trade smaller stuff that could not handle any kind of So that's the only reason they're not shared on the website. It's not that I don't want to share them. It's the fact they just couldn't handle too much money.
Yeah, and which is interesting. But so, can you, I guess, just give the strategy types or concepts of those other things?
Yeah. So I have one strategy called Big Cap Alpha, which basically trades S&P 100 stocks. It is an interesting strategy. It is a kind of what I would call a momentum mean reversion strategy. So it's a little combination of both. Very short holds. That's what really makes it a mean reversion strategy. Another one is a shorting strategy. But this is unique in the sense of it only shorts when the market is below the 200-day moving average. I purposely did not put this out there for when the market is above the 200-day moving average, even though it can do well. But the problem is with shorting, when the market's above the 200-day average, you can really get hurt really bad. And I just did not want to expose people to that pain. I believe shorting is one of the few areas left in the market that there is a decent edge on, but it's just really, really difficult for people to trade it. And you can, and it's happened multiple times, wake up one morning and look, my stock's up 100% and it's keeping going up. It's like, and I want to minimize that potential to people. Another one is Market Surfer, which is I've told you about, is this SPY TLT strategy. It kind of switches between the two. Navigator is the bond rotation strategy that I also have it within my trading stable. Rocket Rail is the mean reversion, SP 500 mean reversion that I just recently put out there. That one's actually having a decent, my version, I think I started because of the rotation, everything's doing, April is a really good year for that. These kind of markets can be really good for mean reversion strategies. And then there's something called Tech Comets, which I discussed a little bit earlier, which is the NASDAQ 100 momentum strategy. And then Volatility Trend Trader, which is the VIXy SVIXy strategy, which is getting hammered this year. The volatility, I think volatility stuff this year.
Yeah. Okay, so sorry, to be clear, they're the strategies that are offered.
Yes, those are the ones offered.
Okay, and I was asking about any kind of strategy types for the ones that you don't offer.
I have a breakout on small cap stocks, very, very small cap stocks that I trade. I have a simple SPY momentum strategy that it's also in my trading stable. I have another short strategy that just trades a different universe than the one on there. And then I have another mean reversion strategy that trades the small cap Russell 3000 kind of stocks.
So when it comes to strategies that are designed to perform in these bear markets, or that we would like to think would perform in bear markets, on the shorting side, let's start with that. So when we're shorting stocks, do you do any shorting that's not mean reversion based, where you're kind of looking for breakouts and holding a position?
I've tried that. I've not been very successful in finding anything on that. The problem with shorting, especially a breakdown and trying to hold for a while, is shorts as the position goes in your favor, your position gets smaller, which is the reverse of long. As the position goes in your favor, it gets bigger, and therefore your gains compound, which is kind of the reverse of what happens with shorting. Good point. I have found that on shorting, getting in and out quickly seems to be better. I've not found anything. I have looked at that. I'm not saying nothing exists. I just haven't found it that anything that's
difficult.
That makes me happy.
And of course, then the problem that we mean reversion traders who are happy to short have is that as the markets are dropping, we're looking for stocks that are overbought to sell, and there's the difficulty of just not getting filled and then not being able to profit on that downside as much as we'd like to. So have you put much research into that at all?
So no. So shorting has some very unique backtesting problems. One is the one you said. Can you actually get the shares to short? We cannot know that in backtesting. There's just no way of knowing that. The other thing we can't, we don't have historical data for, but you can somewhat find out now, is what's the cost of shorting that stock? It could be, and I've seen a couple of stocks come up where it's literally 600%. There was one I passed on last night on placing orders. It's like, you want 600%? It's like, oh my God, this thing would have to completely collapse, for me to make any money off of it. All that stuff is unknowable. So when I develop a short strategy, my general rule of thumb is, cut the returns by like 20, 30%. And you'll probably that's better be what you're happy with, because you just don't know what what the short interest rate's going to be, can you short it, will you be able to short everything? So between all those things that you can just not test, you just have to make assumptions and just cut your numbers by a certain amount. A lot of that you can kind of figure out after trading for a couple of months and say, okay, how many of these stocks did I not get filled? How much did it not affect me? How much did it affect my return? Okay, I see I made 10% less than I should have. Okay, maybe we'll see if that's what I should expect for in the future, kind of thing like that. Because I review my trades quite a bit to see, am I getting filled where my back test says where I'm getting filled, how much slippage, is my slippage bigger or smaller than I expected, and things like that.
So you've got, if I remember correctly, have you got strategies, shorting strategies that only apply in bear markets, and then some that would apply in all markets?
Yes, I've got, yes.
And do they? What's the focus? What shifts in your models? I guess if you're focused just in the bear markets, what kind of changes?
In the bear markets, I tend to be a little bit less extreme of I guess pull up, or is needed in the bear market. Though the other one I do, I expect quite a bit. You look at these charts and you're just like, holy crap, they are just going to the moon, kind of thing. And I'm expecting them to reverse quickly. Those also I get out very, very quickly. The ones that handles any markets, I get out quickly, much, much quicker.
Do you trade different universes necessarily? Or?
Yes. One of them is S&P 500, like the bear market. The one that trades only the bear market is, I believe, S&P 500. The other one is anything major listed, kind of thing. And
then with your long mean reversion, do you tend to deploy again a number of different kinds and styles of mean reversion, or do you kind of package this up? Do you have a particular approach to?
So I have two long mean reversion strategies that are my trading stable. One of them, like I said, is kind of Russell 3000 stocks, and the one's S&P 500. I just let the monthly rotation decide. I've yet to have usually one or the other wins. Usually both of them aren't, for some reason, doing well at the same, or don't make it both into the top 5 kind of thing at the same time. But sometimes they do, and that's okay. I let to me, I guess for me being a long-term mean reversion person, having 40% of my account in mean reversion doesn't feel that bad, or long mean reversion doesn't feel bad.
Yeah.
Sorry, it used to be 100%.
Yeah. And then, okay, so you diversified, you got mean reversion strategies, you got breakout momentum strategies. These breakout style strategies, do you find that they do tend to work better on the more thinly traded stocks?
Yes. I find the breakouts definitely work better on more thinly traded stocks.
These are a trend-following style approach, so do you tend to try and trail your stops rather than have targets?
Yes. I do have targets, but they are quite large. I have targets usually sitting around, I think, 75% gains or so. The reason for this is I just don't want a position to get too big. So if it hits the target, often what happens is I resize it back down to whatever position size the initial was. Since the thing of it's just taking some profits. It's just, I don't like it when positions get big and they start, it's like, oh, all my gains from this portfolio is coming in because, I happened to buy Apple at the right time, whatever it is, and I don't want to have to be so dependent on one stock, going crazy and kind of things like that.
What kind of, trend following strategies would you recommend deploying on the bigger cap stocks? Would you just stay with, say, a momentum or rotational approach, or a longer term holds, or looking for, obviously there's less volatility.
For the bigger cap stocks, I have found that kind of a momentum strategy tends to work better. Than let's say a breakout strategy kind of thing is that's what I'm using as a momentum on my bigger cap stocks.
All right. And then I guess just interested to know about the volatility stuff. So you've got strategies that do trade on the SVIX and the VIXy, so the ETFs, the volatility ETFs. They've struggled in this recent round of volatility. Yes. Is there hope for us in trading these volatility strategies? I mean, what's your outlook now? Where's your research pointing at the moment?
One rule I have is not to make changes to a strategy in the middle of stuff like this, because you're just reacting to the moment. So I'm kind of lightly looking at it, mostly what I'm saying is just the volatility we've, until just quite recently was very, and it still is very dependent on the tweets or the saying of one person. And that's just not normal. So it's just been getting whipsawed back and forth. It's not, So that's, I think, where we've been having a lot of difficulty on something like this. It's just, we go up like crazy for a day or two. He says something, we go down for a day or two, changes his mind, go up for a day. And it's not following kind of normal patterns that we've used to. And even before all this, like I said, this strategy will at times find itself perfectly in sync in the market and just do great, and then other times find itself just completely out of sync and do bad. And I think this is one of those, it's out of sync, and I'd almost say for a reason it's out of sync, because it's just, this markets are just so different, the way it's been behaving. Do I have hope for it for turning around? I'm not taking, it's going to stay my trading stable. I'll say that much. I'm not trading it right now because it didn't make the cut this last, because I did a March 31st, was my rotation period, and it was doing poorly. So I'm not trading it right now. Would I, if it came up next, June 30th, if June 30th it said, hey, get back in, would I get in? Yes. But I'll just, like I said, if it's broken, my rotational thing will keep me out of it for a year or two. And if I haven't seen it coming in a year or two, then I'll decide, what, maybe it's permanently broken.
I do like that approach. And just looking at your, the strategies on your website under your signals service, those, 5 or 6, 7 strategies or so, there are different versions, if you like.
Yes.
With different portfolio options. So what changes? Yes. What changes between option 1 and 2 and 3?
So what changes is usually, just some of the parameters. It's a lot of this is trying to keep people from all going to one place.
Yeah.
A lot of this, I'm not trying. One thing people ask me, I often get asked, hey, can I buy the rules to strategy, this strategy? And my answer to that is no. The reason is I trade these strategies, and I know from experience, as soon as one person has the rules, I might as well assume it's going to get on the internet eventually, and that means it's going to kill the edge. And all strategies, in my opinion, have a shelf life. And I don't need to reduce the shelf life any, because it's getting harder and harder to find strategies that work. What I do by having multiple things is I have different variations, different parameters in them, and then they have different profiles of drawdowns to minute returns. People like, okay, how much do you want to risk and things like that. So it's just my way of spreading people to different strategies, not all of us being on the exact same stocks at the exact same time, kind of thing.
And so something like Tech Comets, give us an outline of that strategy again.
It is what I would call a pretty conceptually simple momentum strategy, rotational. It trades every Monday. It's momentum. Who's doing well, kind of thing. It is conceptually a pretty simple momentum strategy on the NASDAQ 100 stocks. It gets hurt when the NASDAQ turns around. Just this is recently, when the NASDAQ's going up, this is just riding all the nice winners. But whenever the market NASDAQ rolls over, during that rollover period, this is true of all momentum strategies, is the rollover period, you get hurt because you're in it, you're hoping that, okay, it's just a small pullback. It's like, oh, no, it's not. It's getting worse and worse. And it's like, okay, now we're all in cash kind of thing. We're all in a bond ETF.
Yeah. Okay. So that's where the bond ETF comes in.
Yes.
You could rotate into that in a
yes.
in a bear market. Do you do any unusual things in these rotation strategies, like getting out within the period, or using different mechanisms to get in?
The only unusual thing, I guess, one of the portfolios will get out midweek, but it all depends on how much work you want to do. Do you want to follow it? If you want to follow it every day, then you got to follow it every day. If you want, if you want to get out midweek, if you only want to look at it on the weekends, you pick one without the weekend. So that's also kind of like, how much work does somebody want to do? I do the one that lets me get out midweek because, I'm already doing all the other work for all my other strategies for this particular thing. So it's like, okay. And I like that concept.
Awesome. Well, it's a nice mix of strategies. I like the focus on the initial discussion we had too around the stuff that's more appropriate for a retirement account, for example. That's super relevant. I like the diversification of strategies across the mean reversion, breakout, momentum, ETFs, tactical asset allocation. So I think we've covered a lot of ground, and I really I was going to ask you more about your sort of review process, but the reality is, I like how you review strategies. You mentioned that, you're looking at the execution and all of that, but I guess a lot of that is really taken care of through your subbing in and out. So you don't have to worry too much about, reviewing strategies that are doing poorly because you probably haven't traded them for months because they're out of the mix. And
Yeah, I mean, the biggest review comes with a new strategy in the sense of just making sure, are the trades executing like they're expected them to do from the back test? The first couple of months of a new strategy, I'm reviewing quite a bit, the trades, understanding it's like, okay, am I entering? Is my slippage what I expected? Is it worse than I expected? Sometimes it's even better than I expected on a rare occasion, and things like that. That's really the biggest review. It's just new strategies, making sure they're executing as expected. But after that, after they've been in for a while, then it's like you said, it's just my quarterly, hey, and then it's every now and then it's like, okay, let me see who hasn't popped up recently, and do I think it's broken or not?
The only thing I can think of, Cesar, is just coming back to mean reversion and ending there, since you're so well known in that space, and a lot of us do continue to deploy mean reversion strategies, long and short. I guess if there were a couple of key principles for effective mean reversion trading, building good mean reversion strategies, do you have a few kind of words of wisdom to sign off on?
I think people don't focus enough on the exits and the rankings and mean reversion. Those, I think, through the years, those become much more important. Early on, it was, the entries that was really important. Now, everybody knows the entries, but focusing on those exits, trying different ways of exiting, and also different ways of ranking, especially when you get lots of signals, it can make a really big difference on what you're trying. If your goal is one thing, return or drawdowns or, whatever statistic happens to be your favorite statistic, I think those two can really play a much bigger impact than your entries do.
Do you have a way of being creative about when you're looking for these ideas, say for new exits? Do you have a particular process to try and be creative, think outside the box, look for new things?
I mean, for me, I have a trading buddy that we talk to a lot, and he's really good at poking things in my poking at my ideas, tearing them apart a little bit, and also throwing wild ideas my way because he reads a lot too. I read a lot, trading stuff, and every now and then you'll read something. It's like, oh, that's different. Let me go test it out, see if it helps or not. Or, test maybe not exactly that, but it's like, oh, that gives me a slightly different idea how to do something. For me, a lot of it's just reading, reading blogs, reading technical analysis and stocks and commodities, just, getting ideas, listening to podcasts like yours. It's like, oh, there's a new idea I hadn't, thought of. Even though I've been doing this, oh my God, 22 years now, I'm still learning new things. So it's like, oh, I hadn't thought of that.
100%. I really appreciate it. So why don't we sign off with you letting people know where they can contact you and check these strategies out?
Right. So if you're looking to contact me, I love talking to traders. You could go to Alvarez Quant Trading, and there's a contact me form there. Just fill that out. I answer everything usually within a day. Like I said, I answer everything. I love talking to traders. You got questions, send them my way. And then if you're interested in my signal service, you can find more at tranquilitytrading.com. And, like I said, feel free to reach out. I love talking to other people.
And of course, you will happily help people with Amibroker coding and
Yes.
strategy development, idea testing. You've got a group of people that you stay connected with as well in a little community.
So if anybody's looking for trading ideas, but you don't know how to code, I can do it in Amibroker or RealTest. I've got clients all the time coming to me with ideas to test out to help improve their ideas. That's something else another service I offer.
Awesome. All right, Cesar. Well, thanks once again. All the best. Let's keep in touch.
Thank you, Simon. Thank you very much.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.